Me now, Peter Switzer, the founder of the Switzer Report, and he's always good to talk to us on a Friday. Peter, bring us your energy because we need it, because it's been quite a week in the business world. First of all, what do you make of what happened with Westpac and the real earthquake that hit the big bank?
Yeah, I think it's a case of a lot of our big banks suffer from hubris, and look, you know, the issue around ignoring pedophilia linked to bank accounts, it should have been the greatest warning sign that they had to do something and fast. I think that the mistakes were probably process driven, bad systems and all that sort of stuff, but when they were given an alert, and even though it wasn't all that long ago, that there's a possibility that the accounts were being misused, the bank really should have sprung into action and responded positively. And the end result is that, well, the share price fell until Brian Hartzer and Lindsay Maxted announced they're leaving the banks. But it's just misuse of a brand, and the shareholders have suffered as well. But also their role as a corporate citizen has been questioned as well. So it's been a very, very ordinary thing. I don't think there's going to be an economic implication, Pete.
Yeah. Well, just on Westpac customers, should they have any cause for concern? I've had a few people ask me about that actually in the last couple of days, customers of Westpac, and wondering if if their money's going to be all right. Yeah,
because deposits are guaranteed by the government up to $250,000.
Yeah,
I have no concerns about the future of Westpac. Shareholders could suffer a dividend cut if the fine is bigger than what we expect. That's a possibility. But in terms of the security of the bank, I have no concerns whatsoever.
What sort of fine are you expecting? Do you think it'll be in excess of $1 billion?
Yeah, I do.
Yeah,
I do. But how much over that, I'm not sure. The bigger it is, the more likely it's going to affect the dividend.
Okay. So getting back to now the overall economic scorecard for the week, Pete, how are we looking?
Yeah, okay, well, I've actually brought my score sheet as well, Pete. Let's start with the bad first. So past business investment, which is important for getting the Australian economy to grow, it dropped 0.2% in September. So that's not bad result. Construction was down 0.4%, once again, in the September quarter. Not all that bad. But this is pretty bad. Residential building down 10.6%. Now, that's the biggest fall in 18 years. All right, so that is bad, but it is an annual number. The later numbers are starting to look a little bit better, but still, to take that into account, to understand why our economy has been struggling this year, to be down the worst, residential building, really important. And we know part of the reason is the cladding problems, the fact that some buildings are starting to fall apart. That hasn't been a big help, as well as the fact that house prices have been falling unbelievably. Now, the ANZ weekly consumer confidence, it's now at a 4-year low, and I'm not happy about that. That's a real worry. Weekly ones you can't trust, but for the last 3 or 4 weeks, this hasn't been doing well. So that's the bad side. The good side is it's the strongest annual increase in mining investment in 6 years. Miners are really important to the economy. That's a plus. Planned investment up 2.5%. So the plans for business to invest are getting better. And also, I think the fact that the RBA says that they won't go for this emergency quantitative easing type measures, that's a good sign. I hope they don't have to, but the fact that they don't think the economy's going to be that bad that they need to use it, that's a plus.
Well, okay, so you've brought that up. Quantitative easing, it's a term that's been used a fair bit this week. I reckon it goes over most people's heads exactly what it is. It certainly goes over mine. Tom Petrovsky gave us an analogy on the show the other day, suggesting that it's like a plane running out of tarmac is basically the way to explain when you kind of pull that trigger. How would you simplify what quantitative easing is for our viewers?
Yeah, only Tom Petrovsky would come up with an explanation that's harder to understand than the actual problem you're trying to explain. But that's why I love Tom. Look at it this way. Quantitative easing is to effectively increase the quantity of money out there in the economy. You know, in the old days you'd say, oh, they're printing money, but they don't go to the printing presses anymore. What happens is the Reserve Bank looks around, there's a whole lot of bonds out there, there's residential mortgage-backed securities, which is just money that's been put into mortgages. Now, and there's corporate bonds and there's government bonds. Now, the Reserve Bank would go out and buy them. They would buy them from people who hold them, like banks, insurance companies and other big investment houses. They buy them, so the bonds are then held by the Reserve Bank, but the money that they gave out is in the economy now. And so what they want is lower interest rate loans, lower interest rate loans for business, lower interest rate loans for home loan borrowers. Now remember, when the Reserve Bank cut interest rates, we saw that the banks weren't passing those cuts on fully. So the quantitative easing is a way of getting more money into the economy to get more people buying and spending to get the economy growing. How's that?
Very good. I wonder why they wouldn't have done that anyway. And then what happens once the RBA owns those bonds? Do they sell them back at a later date when the economy is back on track?
Oh, gee, you're a very good student, Peter. Exactly. That's what they would do. The only thing is, it is an emergency measure which can create anxiety and negativity.
Right.
And also, they don't really want to hold residential mortgage-backed securities. They would rather just hold government bonds because they're the safest bonds in the world, unless it comes from a few rare countries where you're a bit scared about their future. So I think the bottom line is it's an emergency measure, and what the Reserve Bank governor basically said this week is, look, we don't think we're going to have to use it. Some countries have. It also includes negative interest rates. That's another emergency measure which the Reserve Bank governor doesn't think they'll use. And I reckon if they get close to thinking about quantitative easing, Phil Lowe, I think, would have a bit of a heart-to-heart conversation with the Treasurer, Josh Frydenberg, about possibly bringing forward those tax cuts. Now, a lot of people are saying, oh, you know, Josh Frydenberg has said no to it. By the way, he hasn't said no. He hasn't closed the door on it, but he hasn't said, yeah, I'm considering it. The fact is it's still there, and I reckon the Australian government would rather do that than go into emergency monetary measures like quantitative easing.
Okay. I could talk a bit more about that, but I'm getting the wrap up. So, Pete Switzer, always good to talk to you, but thank you for finally allowing me to understand quantitative easing. I hope our good folks out there were able to understand that as well. So, once again, Pete, appreciate your time. Thanks for joining us.
Cheers, mate.